we're going to help you master everything you need with the asterisk for your next funding round. So hi, I'm Anthony Rose. I'm founder and CEO at SeedLegals.
Okay, cool. Hi, I'm Alexej. So my background is in finance. I spent 10 years in finance and as an investment banker, and then in venture capital and private equity. And then 1.5 years ago, I started Alphagreen, which is Europe's largest marketplace for CBD products. We raised 1.1 million. And we also built on the side a digital growth agency as well. I'm very excited to be here. So thanks, Anthony. Yeah, very, very good points here. And Anthony, I completely agree that you have actually a line for investors and a line for customers. In our case, it's leveraging a marketplace to build an ecosystem around sleep, pain, and anxiety, which is the investor story. And then for customers, it's just as simple as alpha up your life because you get the best products on Alphagreen. I would just, because a lot has been said and everything is correct, I think I would tend to agree that, keep it simple. Don't provide too much information. You just want to grab the attention of the investor when he sees the deck, and then you can really talk much more about the details in the meeting or in follow-up meetings. Mm-hmm. And yeah, the way maybe one thing I would add, which usually is not mentioned by any of these templates, by Sequoia, etc., is to actually use examples of successful stories in either your industry or for that business model which you're doing. So if you're trying to do whatever, another food delivery business, obviously use food delivery success stories as an example, same for fintech, etc. So I think giving that sense of success and sense of, okay, this is the potential exit, or this is how I can actually make money, gives the investor a very kind of quick, let's say, item to digest, and then you can really talk about your story in more detail.
Okay, so by the way, just coming to the, use successful other ones. If you read Business Insider or others, you'll see, here's the pitch deck that Uber used to close 27 billion or something. Unfortunately, in my view, these are completely useless because there's only one slide in those pitch decks that investors look at, which is the growth slide. The rest could have, yada, 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 banana, yada, yada. Nobody would look at it until they get to the slide that go, holy moly, this is your monthly growth. So the problem is the ones that are successful, firstly, often US examples because they raise lots more. And secondly, they're often sort of much later stage, and they're not really helpful because your growth is still zero because you pre-launch or you've launched and it's sort of modest. And
it's also survivor bias, right? It's like the ones you're getting that information on are the ones that made decacorn status or unicorn status, now looking back and going, didn't they do a great job? It's like there's loads of other people who presented the same shitty pitch deck and got nowhere.
Exactly. So Alex, you did your round during COVID, is that right? Or was it pre-COVID?
We started actually pre-COVID. So in fact, I actually planned, because I've been actually an investor my whole life, I actually planned a cannabis investment fund initially. So I had already investors lined up for that idea. I then traveled the US and Canada and then realized, okay, I don't want to do an investment fund. In fact, I want to build a platform to distribute the products and really build a tech platform. And so on the one hand, I kind of had already investors interested in the industry. And on the other hand, I just, got and reached out to new ones. But I started raising in December 2019. And in February, I closed the round. And you can kind of argue that, well, if you look at Asia, COVID was already there, but of course nobody paid attention.
You were still pitching in person. The reason I asked this was to get on to the next thing, which is the art of the Zoom pitch. So most of your pitching was before, but you said you did like a 2-stage round. So was the second stage now in COVID or pre as well?
Correct. I did basically as kind of an extended round in so August, September, October. I closed basically the second half, and that was all via Zoom. Well, We use Google Hangouts, actually.
Okay. All right. So that takes me to two things. Number one, you can do rounds in COVID. And I think what we saw at SeedLegals is when COVID hit in sort of March, April, well, March was insanely high levels of activity as everyone closed their SEIS, EIS rounds in the UK before April the 5th. But then there was kind of a lull. But what I found was that the smartest founders who happened to be in the right sectors, medtech, edtech, and so on, were still out fundraising. And then the smartest investors who want to be part of the best rounds had to stay in the game. So in fact, there was a sort of brief lull as everyone went, what's happening? But then, people didn't procrastinate. And then, of course, you went, doesn't matter. I'm now rethinking the business, I guess, creating a deck that's going to be as appealing in COVID times. And then I think, by the way, my advice when I see decks that don't mention COVID, it's like, dude, it's the elephant in the room. Don't pretend COVID doesn't exist. Don't even slightly acknowledge it. Embrace it. I mean, obviously, if in the travel business, you can't skip it. But even for others, in your case, you might show how people are at home and doing other things or, whatever it might be, how you're going to benefit more than anyone else. And although we kind of see the light at the end of the tunnel, realistically, it's going to be 6 months or whatever till things are back to normal in any significant way, is my assumption. So you should plan your funding activity based on that. Yeah, so I think the pitch deck and the pitch is, in a sense, I always think of Jack Nicholson in As Good as It Gets. So there are a bunch of questions about funding and the way to do rolling closes and so on. Just before we get to the next step, I think one quick thing from me, and maybe ask you guys as well, which is the art of the Zoom or Hangouts or Meet pitch. And so here's my quick thoughts, which is you're never going to show the investor that you're going to change the world if you can't sort your lighting, can't sort the camera, don't have sound, and when your pitch deck, you turn on screen sharing, you're still fiddling around trying to get PowerPoint's slide sorter and header to go away. So thing one is prep your PowerPoint beforehand. If you're using PowerPoint, put it into read mode, not full screen, because full screen will take over the screen, or put it on your second monitor and everything will go badly. Read mode, drag it out to a decent screen size so it's not trying to show a tiny thing. And now when you turn on screen share, it will immediately be in that sort of full screen rectangle rather than you messing around with it. If you want to run a video, the latest version of Zoom, I think now does native video better, but videos never worked really well on Zoom. They're always sort of, a couple of frames a second. But if you do want to do video with sound, make sure you switch the sound input to the video player and then back again. Otherwise, there'll be an awkward discussion about there's no sound. And so you want to be super slick. You're in, doing your pitch, get rid of the screen share, question time, and only then will people believe that you're going to change the rest of the world. So, Alex, thoughts on your online pitches?
I guess actually with COVID and the fact that we have the investor's attention now, and he can't just say, okay, look, I need to, I guess, go switch out of the screen. I mean, of course he can, but ultimately we have him glued to the screen. It actually allows me to jump into, for example, the Google console or Ahrefs, some tool we use for SEO. So we actually can show way more than we could have shown him in a physical meeting, where you wouldn't just say, hang on, let me change to another presentation or to another screen, right? So in fact, we do, of course, let's say the pitch, or we did, but throughout the slides, I actually even went and said, you know what, let me show you our traffic in real time, and this is what we do, and this is how our competition looks like, right? And so that was actually really useful. I mean, again, we are an e-commerce business here, so it works. If you're in a fintech company or if you're a software or deep tech company, it might not work as well. However, there is so much stuff you can show to investors. How do you manage your team, maybe using Trello? How do you track your team potentially, right? So, and I think investors, once they see it, they will be super excited, because they're obviously not using certain digital tools. And so I think it's actually a really big opportunity to leave a massive impression on the investor nowadays because you do it via Zoom or Google Hangouts or Microsoft.
And I agree, because when you're standing on stage, it's sort of like naked and afraid, everything has to work perfectly. Or when you're sitting in a Mayfair office or something with an investor, you've got no backup. Whereas here, you can be slacking your team, I need this, or you can pop up something, you can have tabs open, ready to share if investors ask anything. You can be looking ahead at the next slide you're going to see. So actually, life is much easier in a sense on a Zoom presentation. So Alex, you were nodding. What's the secret in your case?
I think the secret is to really start with the problem and the market size, and then, talk about the numbers, right? And as you said, most companies, when they go out, and probably the majority of the audience here, they go out and they don't have revenue, for example, right? Or maybe they even don't have active users. So how do you actually convince an investor? And so the reality is you have to tell them, look, this is a real problem we're trying to solve, and this is a huge market, and this is how we're going to go about it, and these are the unit economics, how we will make money, right? So, and this is exactly what we did, right? I mean, we launched, when we raised the money, we didn't have any sales, we didn't have any users, we had a landing page, we started obviously doing content to get SEO, we started seeing impressions, started seeing clicks. But the reality was like, okay, look, it's a multi-billion market, and it's huge in Canada, it's huge in the US, it's now coming over to Europe, and we're going to be the leading marketplace and player in Europe. This is why you should invest, right? And so that was the story, really, right? So we leveraged the industry and the hype of the industry. But of course, there are different industries and different business models which have to take a very different approach. And I think, you just need to read, material from VCs, from other entrepreneurs on your industry to understand what is the best angle to pitch to investors. And I think then you can many different ways lead to Rome.
So looking at the slides here, yes, we've discussed alternate mechanisms. So there is debt used to mean you call the bank and they lend you money, right? The problem with that, the bank gets, 5 or 8 or whatever % interest. So that means they need like a 96% chance they're going to get their money back again. Otherwise, it's a losing proposition, which means they're going to want to do so much DD on you, and you can only borrow money if you can repay it. So the reality is, for most startups, you don't have a business yet. You've got a lot of CapEx. You need to build stuff. It's unproven. So you can't borrow money. Do not think of borrowing money unless you've got a revenue stream to repay it, or you're just setting yourself up for bankruptcy. And so that means pure debt finance is off the table for most early stage startups until they're generating revenue. But there's the emergence of new fashionable things. I think Clearbank is one of them, which is that they will lend you money if you spend money with Facebook or Google on advertising. It's an amazing model. So the idea is, if you have a scalable business where you are making more from the lifetime value of a customer than on your customer acquisition cost, such that the reason you'd be raising money is to buy more customers, which you then monetize. Normally what you would have done is you'd have raised £1 million, given away 15% of the business or whatever it might be. But actually, these companies would argue there's a better way. We will lend you money to give it to Google and Facebook to buy customers, because you're going to make more money from those customers that you can then pay us back. It's like, hang on, you can lend me money to give it to Zuck? That's really weird. But it's actually quite a good model. So between that, convertible notes and so on, there is actually space in the debt area, but it only really works if you've got revenue that you can repay the debt. Otherwise, it's not going to work.
Yeah, I think to quote their figures, I think they say £10,000 monthly recurring revenue and about 6 months of data they can plug into from Stripe or whatever else you've been taking payments from is typically about the amount they come in at.
Right. Okay, so let's go for a couple of quick-fire questions here from the team. So one from Joe: do early-stage investors need to see the next round planned out? My take is the answer is no, but they would like to see what your plans are for the coming next 3 or 4 years. So if you're showing that your business is going to grow at 20% year on year, it's of no interest to an investor. If you're showing that on year 5, you're doing 200 million a year in revenue, that's awesome. You're a FTSE 100 company, but chances are it's not going to happen. So I think the investor's looking for the next, for the right level of ambition to see if you're a match for them. They might also want to see something about the next round so they understand how long their money's going to last for. But at least for me, it's nice to see you thinking about it, but I know quite a lot will change between now and then. Alex, do you think you'll do the next round?
I think you basically want to show how long this money will last you for in, let's say, a best case and a worst case scenario, because of course investors don't want to get diluted, so they don't want to hear that this money will only last you for 6 months and then you have to go and raise again. But ultimately, yeah, it's more about, the big picture again. Yeah, as Anthony said, yeah.
Exactly. So that takes us to the neatly next question from Elisa, which is, actually doesn't. It takes me to Dan's one, which is EU and UK investors versus US investors. And are they different? And the answer is, I'm always really envious about US funds, because the companies that are exactly the same as UK companies will raise 10x the amount at 10x the valuation. And you go, that's why is life so unfair? How come they're raising it at 50 mil and dollars and we're struggling at a £5 million valuation? And I think it's because US investors take a slightly different view, which goes exactly to this, how long will the money last? And I think UK investors look at it as in, every time you raise, I'm going to get diluted further. So I would like you to get to cash flow break even quite quickly so you stop diluting me. US investors go, every time you raise, your valuation goes up, 5x or 10x. So you should raise shitloads more money because my valuation will go up, and then we'll own the world at the end of it. So it's a very different risk profile. And I think it comes from, UK companies. There's just not that many unicorns. There are a lot more in the US. And so everything in the US, the funding mechanism is built around that to take much bigger bets for much bigger returns. Whereas here there's a realization it's unlikely, most early stage startups may exit for 20 million or 50 million or something, which is amazing for the founders, right? You're millionaires, but for the investor, I've made like a 3x return. Nah, is it worth it? And I think that then drives the fact that the investor is going to not want to see you applying more and more money into the business. They want to see a path to profitability. So I asked, what about accelerator programs? Would you suggest those as opposed to angels? So Elisa, my take is that there's a bunch of accelerator out there. I mean, accelerators, if you can get in and it's a good accelerator and you're looking to not really get investment, the principal reason for going to an accelerator is probably the learning, the connecting with other founders, the becoming a founder, the learning the ways of products and MVPs and so on. The fact that they will invest 100K or 50K, I think is a part of that. Check the terms. Some of them are more or less generous. So Antler invests about 100K on a £1 million valuation, which is extremely generous for people who have not even thought of the product yet. But, there are thousands and thousands of angel investors and dozens of accelerators. So your chance of finding angel investor money is probably greater than being able to get into an accelerator. So Martin asks, what sort of return will an investor want? And that's really a fascinating question, then comes right back to, should you find angel investors or should you find funds? So angel investors are going to get their SEIS or EIS tax deduction. And if they keep their shares for 3 years and sell them, they pay no capital gains tax. So for an individual, if you could get a 3x or 5x return on your money, you invested 50K and you got back 250K in a couple of years, well, my bank's giving me 0% right now. So, and I've written off some tax. That's a fantastic return. But when you go and talk to a fund, they do the power law and they go, I do 10 investments, 3 of them will fail, 5 of them will return kind of like 1x to 3x, and one of them needs to return 50x to what's called return the fund, pay off the whole fund. So for a VC, they're going to play their investments like a game of poker. Maybe an angel investor will as well, but they're kind of betting on red or black. But the VC is putting their money on like 26 red. So you're either going to go big or you're going to go bust. But for you as the founder, if you went back to your spouse and said, honey, there's a 95% chance we're going to go bust and a 5% chance we'll be billionaires, he or she would probably say, dude, you should get a proper job because those are not good odds for us. Whereas if you go, honey, there's a 70% chance we'll, get a 3x and, exit for, $1 million or $2 million in a couple of years' time, that will probably get a much better response. So for you as founders and for investors, they're often looking for very different things. And it's actually really important, coming back to, what Alex was saying about finding the right investor to match your ambition. If you have a modest growth ambition and you have a hugely aggressive VC, they're going to be pushing you to do things, to take risks, to expand in 27 countries, to massively increase your burn rate, to play that game of poker. But you may not want to be at that poker table. You might want to have a much more stable, less stressful existence. And saying if you can double your revenue each year, I mean, that's amazing. 200% increase in revenue, whereas your average high street store is a 20% return on, increase in revenue. That's fantastic. But then go and find investors that are looking for that.
And will be appreciated by the investors, and therefore they're a lot more likely to take you seriously, I think.
Okay. All right. So to close, number one, if you need help looking for investors, hit up Ed at angelinvestmentnetwork.com. If you've found investors and you want the fastest way to close your funding round, hit up Anthony at SeedLegals.com. And if it all becomes too stressful for you and you need to relax, call Alex for a good time. All right. All right. Thank you, everyone. That's been fantastic. I hope it was helpful on your side. Certainly, we've had fun and a great conversation. And thank you for the awesome questions as well. Thanks, everyone.
Thanks.
Bye.